This is Justin Pulitzer. This is my weekend video for the week ending March 8th, 2015. There's a lot to cover. We know that we had some employment news on Friday that took the market down rather sharply and created a lot of talk on the news, the talking heads, and on the stream. But before we get into the markets, I want to discuss a few things that I've been noticing on the stream that have been disturbing me, and I'd like to address them quickly. Sort of a fireside chat, if you will. So the first one is that I'm noticing a lot of people have way too many positions on. As a rule of thumb, I usually think about 5 to 7 is manageable. Anything more than that is getting a little bit tough. It's hard to follow each position, and I think you're going to wind up spinning dishes and sort of be herding cats if you're above that. If you have a pretty big account, and I mean like 7 figures or more, you might want to be able to do 10 stocks or so, but anything really above that is starting to get a little bit much. The other two are people are chasing at bad prices. I would say both more on the long side than the short side, but in general, I find that people are sort of chasing moves after they've had multiple days up, and then they sort of aren't rewarded, and then they wind up puking out their position when it doesn't go well. Keep this in mind when I discuss Google. I'm going to come back to that in a little bit. And one of the last ones is that they allow their position to influence their bias rather than allow their bias to influence their position. And by that I mean it's like you own Apple, so of course you're bullish on Apple. It's not because you're bullish on Apple that you're long. So it's because you're already in an existing position, you're allowing that to influence your opinion of the stock. That is wrong. Always allow your bias or your view of the stock to influence your position. So that being said, everybody wants to be on the right side of the trade. And, a lot of people don't realize that it isn't wrong or right. There's a step in between. You have to first stop being wrong before you can be right. And the same thing the other way. You have to first stop being right before you can be wrong. There's that subtle transition in between, and that's where you should be very diligent in your risk management. Anyhow, fireside chat over. Let's discuss the markets and some stocks. So let's jump right into SPY, why don't we? So I had discussed that anything above this 208.97 was a breakout. You can see we had a look below and a breakout, and then weren't really given very much for it. We were kind of approaching the top of this channel, just chopped, and then we sold off. Now, if you follow me on the stream, I had said on ES that anything below 2107 I thought was a little bit suspicious, and you could see this day here we had breakaway value here, meaning we gapped down and we never really got back into the meat of the move from the prior day. The next day we kind of came up a little bit, but then on Friday we had that jobs number and we had a liquidation break. I think there was an initial spike in the pre-market, and then it just kind of fell apart. And I think a lot of this was just I don't want to say market fatigue, but I think a lot of people who were long and kind of frustrated, and there's some fear of Fed rate increases later on in the summer. So I think a lot of people just got stopped out. They had been in at bad prices, or maybe they had bought in this consolidation, and then they probably set their stops in here, and then they just got flushed. So where does that take us? Is the market rolling over? Is it really very bearish? The answer is I don't know yet, but I will tell you a few levels we need to watch and some of the cautionary signals, if you will, that we could look out for next week. And I'm going to discuss the way I'm looking to play it, how I am playing it, and how I'm looking to play it. So let's go through the levels. Let's zoom in. Let me see. Am I? Yeah, I'm on auto. All right. Anyhow, take a look. We were below this reference high, and we're kind of into below my caution level. You can see this 207.84 to me was a cautionary level. And for me, so far, this is a rather normal pullback, because the breakout here was this 206.42, and you have a 50-day moving average that's right here. You can see on this kind of false dawn breakout, pullback, the 50-day held, and then we rallied up. So I think if the market is to be healthy, so to speak, a successful test of this area, I think, is okay. And I would say it's actually healthy. If we start taking out this 205.38, which you can see is marked on my chart, which is what I designate as the range low. It's a little bit below these highs of this 206.42, but if we're coming down like on some news or slam down there into some momentum and it holds and then rallies back up, I would say it's quote-unquote still okay. It's within risk tolerance. But anything below this 206.42 and anything below this 205.38, you've got to be really on cautious mode. I would say this area is a great right or right out buy for a bounce. If it's wrong, you can reverse really rather quickly and look for a short for maybe a retest of this. It's really not that much room, but it would be obvious to me that we would come and retest this area. And you can see that's also very close to this 201.90, which was a gap around here. So if we lose the 50 and this range low, I think we're going to come back down here. Excuse me. Come back down here to fill this gap around 201.90. Now, if we talk about open interests in SPDR, SPY options and expected market maker moves, the expected move for next week is $3.22, and for the March expiration, it's $5.01. And if that was an up move, that would take us on the weekly to 210.72, which you can see roughly is right around where this breakdown took place. If it was a down move, it would take us to like 204.28, which is roughly a little bit, I mean, this might move up a little bit, but it's roughly a little bit above the 100-day moving average, and that would be that down move. But the more interesting one to me is the March expiration, which is the quarterly and monthly for Q1, which is $5.01. If that took us up, that would take us roughly up to the highs, up to 212.51. But if it broke down, it would take us to about 202.49, which is really roughly around this 202, really the 201.90. So that area to me, the options are confirming that in play. Now, the one fly in that ointment is the VIX. The thing I do like about the VIX here is you can see we are consistently making lower highs and consistently making lower lows, which is bullish for the market. If the VIX were to do something like just come back up and retest the trend line, it would be back up into the 17s. So that would obviously elevate the expected range for the market, and those figures might be off a little bit. But as you can see on my chart, oops, I didn't mean to. Boy, this is getting messy. Too much clicking, right? Let me just delete that. Sorry. Anyhow, I've always said on the stream that I think anything below 1757 to 1785 is still the bull's ball, so to speak. The ball is still in the bull's court. Anything above there, you can see I have a secondary downtrend line drawn. I think that would take us up pretty quickly to the 19s or close to 20, which would be, fairly standard, the usual panic. So as long as we're below here, I think you could still play quote unquote buy the dips. If we get above there, you might want to just be step out of the way and kind of let things shake out. So that's SPY. On the other hand, you have IWM, which is now roughly retesting the old high, which is still quote-unquote normal, although there's one little caveat, caution. I had discussed that this sort of, it's not an official regression line, but it's one I drew in from the lows here. You can see it's supported here, and then you started having failures at the back side of it, and we were kind of just riding it, and it kind of fell out of bed a little bit. So as long as we're over this 20.97, it's still okay. On a breakout pullback basis, you could see the 50-day is right around there as well. That's that 119.39. If that were to snap, you can see this channel low roughly comes into play with that 117.37. That, to me, is the absolute must-hold. If that breaks, you are going to see something pretty nasty, like maybe this. So I would be really, really cautious if this trend gets taken out. This is, to me, is really the primary trend of this up move. It's also this really key level that it took a really long time to get through, and nothing above it was sustainable. Finally, we got some clearance over the old highs, And then if we came back down there and supported, I would say it's still okay. But I am definitely would be on a more cautious mode below this 220.97. But I still think anywhere in this space is healthy and okay above the 50-day. So let's just use that 50-day and the 119.39 as the stop if we're long IWM. I'm not playing it that way. But I'm more in stocks. I don't really play the ETFs that much. I do play ratio trades on there, and I'm going to discuss that. Actually, let's go back and discuss that. So I had put on a play for the monthly where I bought the 206 calls and then I sold 2 times the 202.50, which I had discussed with you guys was be the downside measured move. If we came down here really, really, really sharp, I'd have to do some type of an adjustment, and I'll discuss that on the stream if it happens. I'm not necessarily anticipating that yet. I'd be looking at a defensive hedging play if we lose the 50-day and we lose this 205.38. Then I'm going to start thinking contingency scenarios about down here, and maybe it's fancy talk delta hedging, which just means shorting shares if we puncture this level as a hedge against the overwrite of those of the puts. So like I said, I had owned let's just use 2x4 since we're going to keep it simple, or 1x2. Let's just use 1x2. Let's just keep it simple. I own, in this example, 1 206 put, and I'm short 2 of the 202 halves. So I'm short 1 time as many. So the break even really comes down below here, roughly, actually in 196s, so it's below the reference lows. I probably won't do too much as far as hedging if we came down there, because we do have like the 200-day moving average and a really big strike at the 200. But I would be on caution mode if we did come down here. I'm not anticipating that yet. I want to see how this resolves, but that is the play I'm doing. If you're following along, we'll discuss if we start getting down here and it starts, particularly if it happens in a sharp manner. If it's slow and it's a grind and choppy, it's fine. If it's really sharp, then we're going to have to do some adjusting. Let's go to the Qs. Q of the Qs. So the Qs still have some nice relative strength. We're still above the 20-day moving average, which is good. The reference high, which we could just come back and recheck, is the 106.25. So I think anywhere in there is okay. For me, it gets a little sticky if that gets lost, but for me, anything between the 106.25 and the 105.26 is still okay, with maybe some slippage to 104s. I realize it's a lot from where we are, but I mean, look what happened here. This was the downtrend. It had, reference highs here, it broke. So this to me would just really be retesting, and the 50-day is down there. So that to me would be just retesting the breakout. All still very normal stuff. If this gives, I think we do see we see this kind of not primary trend, but like the secondary trend, and maybe a retest of the backside of the prior downtrend, which would be roughly down by the 100 MA, which is 102s. So if you're doing some type of a put ratio, you probably want to be long something up like in this area, and then short something below that area 2 times for the play for a move down. If you could get that on for a small net credit or for even, that to me is a really nice hedge to play, a really cheap way to play downside into reference support. That to me is a phenomenal play. One of the things that has been a driver here is this long bond, this treasury, right? I had discussed being short up here. I covered way too soon, some down here and then some down here. I'm really sorry I didn't hold this because I had some really amazing trade location, and this thing could have gotten, this would be an amazing winner. But I have played some isolated intraday stuff. I haven't really talked about it that much on the stream, but you can see this is looking fairly bearish. You broke down below the channel here, kind of like looked below into the prior old channel. You can see this was the more sustainable channel. And then we rallied back up, checked back to the 50-day, and then completely fell apart below these lows, and now back into the 2009 peak, and also roughly around this area. So the levels have been rather important. To me, this is a key level right here, this 123.15. It held there roughly here, so there might be some type of a oversold bounce up to here, but I really think that the risk is still down to the 119s, which is possible, which you can see is the low of this channel. Since we broke back into it, there's also a 200-day moving average and some other reference areas and this kind of chop area. So I think if we came back down here, this would be the better right or right out play for some type of a bounce, maybe back to the downtrend. But this is concerning if you're a bond bull. I was on this Benzinga show roughly around here, and they had asked me what was the what anything I saw as overly valued, and I said TLT. And you can see that turned out to be quite prescient. I'm going to post a link in the description below. So if you're interested in hearing that, you can do so. So that's TLT. One of the things that you want to watch for confirmation is the XLF, which is the financial sector. If yields are rising, technically that should be good for financial stocks because as the yield curve steepens, they can borrow at the near end and lend at the long end, which is really just fancy for borrowing cheap and renting expensive, so to speak, renting out the money. It's curious though that on Friday with that breakdown in TLT, XLF was really just a look above and fail. You can see it this 24.57 and this downtrend line, it kind of got above there. It didn't have any traction, probably just because the whole market was so weak. But this to me is a little bit concerning if you're really still short the treasuries, that this couldn't kind of hold itself. I would say the 50-day, like roughly around this 2408 area, maybe a little bit below the 50, somewhere between. This volume distribution is key. If that gives, you could do something like come down to the 23.68, and I don't want to say it's an inverse head and shoulders, but if it could be like you come down here and then pop up. But I'm a little bit cautious with this bar. I wouldn't be I would be waiting until this gets taken out. If you can take this bar out, the high of this bar, this 2466, I think you come up to the 25s pretty fast, and then maybe some type of a fib extension higher. I didn't do the calculation on it, but it would be higher than here. We're in a responsive market, so there'd probably be some profit taking up here in the 25s. I would do the same, but you probably want to trim a little bit and trail up the stops, and then play for higher if there really is continuation in the XLF. One of the other ones that have been getting is coming into some key levels is the IYR. This is the real estate ETF. You can see it's roughly testing the old high, which was from I think back in 2007 or what have you. It had broken out, and now it's just rechecking. So I think that in between this area here, the 76.21 and really the 74.95 is really the key hold for this. It's also the 200-day. If that breaks, we're probably going to see trend down in the 72s, which would roughly be about 50% correction. So that is this to me would be an amazing right or right out area. Maybe there is a little bit of slippage. Maybe you want to sell some puts even. Like you could sell the 70 puts down there once you get to that area or something below it, and give yourself a little bit of leg room. A little bit of breathing room. You could see if that snapped, it would fill up the triangle to 68s. So this would roughly be where you'd want to be, quote unquote, getting long for some type of a bounce. I'll be a put seller down here. I'll probably set some alerts after the video. Let's go to the meat. Apple. So, all right. I had been discussing that anything break out of the 119.75 would put this 128.97 into play. It wound up being correct. It actually even wound up overshooting a little bit, and now is pulling back. You can see on Friday, Apple got added to the Dow Jones Industrial Average, or is going to be added, I should say, and it had a bit of a spike and had a lot of relative strength. I said pre-market that 129s was a gift and to take it and to sell because the prior day had broken the 20-day moving average and closed below it. You can see, and to me, when Apple is below the 20, it starts signaling a bit of weakness. It was also below this reversal bar, which had looked below this channel, closed above, and the fact that we lost it has me thinking a little bit more bearish. I'm actually in a play right now with Apple. I'm long, again, one of my put ratio deals. I'm long the 123 puts, and I'm short 2 times the 120 puts. So that would roughly play for a check back here. You can see, I think that this trade becomes a problem around 116 or 17. I have to play with the math quickly, but this area to me would be is a good right or right out buy. This was the gap up, the earnings gap high of day, the 118.12. anything between 118.12 and 119.75, I think that is a healthy correction. It's a buy the dip scenario for some type of a bounce. I don't know if we get back up to the highs so quickly or what have you, but it's definitely a good day trade bounce or some type of a good thing to be playing for some type of a long for right or right out. If that fails, then I think we can come back down maybe to first of all to 115s, which was this area, and then maybe even to 111s down in this area. Like this would be the low of the channel. It would get kind of close into the, I don't know if you get the full fill to 109, but you might get a fill into the top part of this area, which is like 112, 111 on some type of an overshoot to the low of this channel. And that area I would say is a stronger right or right out. But I would see something maybe like this, and then you bounce a bit, and then maybe it comes back down. We'll see. It's also conceivable that we get higher. If you could get over the Dow Jones Industrial, this kind of reversal bar, if you could get over this 129.37, was that what it was? Yeah, that's the high a day. I think the pre-market was 129. Let's just say over 129. Let's say you get into 130s. Let's take 129 off the table. Anything above 129s into 130s, I think, is long, and then you could play for a move up to this kind of resistance line that I had been talking about. I made it gray because we seem to be breaking down, but if you could get above 130, I think you're going to take it into even maybe 138, 137, 138, depending on how fast you get there. Anything below there, like I said, this area to me would be in play. If that fails, then we have a channel here. And then I think that would be the buy for the bounce. You can see we're kind of a country mile away from primary trend. I don't really think that's in play anytime soon unless the market falls apart. But you can see we are selling off on increasing volume. So I do think that there is more corrective action in Apple that is very likely. It could be a case of sell the news. The event is on Monday. If there's some type of a sharp spike down, you might want to use that Jack premium to sell some out of the money puts. Amazon, wow, that took a little bit longer than I would have liked. Amazon, I still think the old highs are potentially in play. If it starts getting below this big bar, these like let's say 376s, then you might want to be a little bit cautious. Anything below the 72s, I think you got to be out. It'll probably retest 68s and maybe even come back down and test 358s, where I think this backside of this old up channel to me would be a good right or right out play for the 358s for some type of a bounce, whether it's a day trade or swing. However, American Express, I had discussed that this was starting to look a little bit better. I actually got out. I had been long, and I got out on the downtrend line. It turned out to be prescient. I also had on some also, again, put ratios. I don't want to get into too much detail on this because we're burning up too much time. But American Express here below 80.57 is a little bit vulnerable for obviously a retest of this trend line, which would be down here around the 78s, and potentially still for the gap fill at 76s. I think that this thing would be a screaming buy on this other gap fill down in 72s. I don't want to go back to and spend too much time on the chart because I've reviewed it before. If you're curious, just check out my last week or the week before. I do the analysis on, again, Amex, lower highs, lower lows, careful. What you need to see is this pattern reverse, or you need to see like something like equal lows and then take out of the downtrend line and maybe the swing, and then I think you can play for a move higher. But the news cycle has been bearish, and I think you might need to sniff a little bit lower. For me to be long, I would need to see a move over this 83.47. That is Amex. BABA. So BABA is a little bit tricky here. You can see we had a breakdown here, a look below, and a close below, still making lower lows and lower highs. A look below these old lows, and then the next day it had this like amazing reversal bar that engulfed the entire thing. The day after, you made slightly higher high. You basically closed above the bar, a body of this bar here, and then unfortunately on Friday, I think and got the 20 MA. Unfortunately on Friday, I think the market was just too weak for this thing to have follow through. I actually thought that there was a potential on Friday to have a gap and go, but that scenario never played out. So if you're really, really short term here, you don't want to see anything below 84s. There could be, I think that the stock is might be a little bit choppy. It's also potentially possible that there's some type of a move back higher, but anything below 84, you want to be cautious, and for sure, anything I would think below like these lows here, these 83.75-ish. So yeah, 83.75 to 84. You probably want to be out if you were trying for this type of a play. I would think that anything below these lows here, this let's just call it 80. Anything below this bar's low, 80.17 or 80.03, I think this is a short, and this thing could even possibly take it. I don't want to get too crazy here, but the thing could possibly get into the 60s. There is a lockup that's coming up, and there could be some overhead supply. But I am playing this bull along. I have a bit of a risk reversal on. I did it small as a test. If we start taking out this low here on a sustainable basis, I will be out of it and just take the small loss. I did it small, a tester. It would give me some information. If we did take out these highs again, this 86.27, so 86.28, I would actually be looking to add to the trade for a move higher. So stop below this area, add above this area. Really simple. YHOO, I had discussed also similarly being a long near these reference lows. I was actually looking for a little bit lower on the channel touch, but the 200 held it, and now we're just sort of in range chopping. So YHOO really needs to be above this 43.80. It closed a little bit below there. I would say that if you're looking to buy YHOO, anything over these 2-day, or let's say this bar, this big reversal bar day high, that is 44.38. It's interesting that BABA had gotten over it, but YHOO didn't. So that might be a little bit of a tell or some caution on BABA. Like I said, I'm still a little bit long on that with the risk reversal, but it's small, and I really have no major skin in the game. Be happy to just take it off for a small loss if it doesn't perform early next week. But 44.38, anything over that, I think you can play long, and it'll probably go a little bit higher, maybe up to the 50-day moving average to retest and maybe fill the gap there. So that is YHOO. BIDU. Again, a responsive market. You can see the breakdown was above here. We got a little bit close to the 50-day moving average and just pulled back. If you're long, hey, Friday's low is a great stop, right? You're right on the 200-day MA. Anything below there, maybe it puts a little bit lower into play. I'm not really... I used to play this stock long a while back. I had some really good success. It's not one I've really followed that much lately, although I did put up some levels for the earnings. I think it had gotten down to 91 in the earnings, on the earnings gap. So that area I would think would be a great right or right out type of a play, although you can see it would have been healthier if it came down there sooner. It might not be as easy if you get back down to these 99s because you had gone up, came here with a bit of a higher low, slightly higher high, and if it took out this low, then I think there could be some more cascading action, particularly if the market is weak. But if you're playing this, I would say the better play is to buy it on a break of the down channel. You can see we're still in a longer term up channel, but we're in a down channel within the up channel, if that makes sense. So we're having a correction within an upward bullish trend. So I would say any break of this down channel is a buy, probably for a move back up to these highs and maybe even to infinity and beyond, right, as Buzz Lightyear says. But that is my analysis on BIDU. I would be more of a trend breaker buyer, or a channel breaker buyer, or whatever. If you can break the downtrend, then BIDU is back on my buy the dips list. Salesforce I had discussed being a probably having some. Actually, I kind of expected this, and I had said that I thought it would be a buy down here at the 64.74. It wound up being a good bounce, but now we've taken that out. So if you're long, you want to be careful. I think that the better buy now, if you can get back above this bar, like these 2-day high, the high of that bar was 66.06. I think if you can get above there, then I think the trade is back up. If it kind of lingers and languishes below, then 61s to me would be in play. You might want to do some type of a put ratio with like 59s as the bottom, like the terminus strike. If you really want to play it conservative, 57s, like roughly around the old uptrend. I don't necessarily know if we get back down that far, but it has been a good buy area. So I might do this with some type of a put ratio with 57s. I have to look at the premium. I'll post it on the channel on the stream this week, which is there'll be a link in the description below to my Twitter handle if you're not already following me. So that is my thinking on CRM. Facebook. I traded this one this week. I've been long since we were over this reversal bar here of the 76.88s. It's came up. It's just had some responsive selling roughly around the 80 and then in the 81. And now as we got close to 82, I still think this is going to be higher. It's just choppy. If you start losing, this range in these 78s, 78s, then I think it gets a little bit more iffy. But I do think that this pattern will eventually resolve higher. It's just been choppy. You could do something like hedging by selling some upside calls. What I did was I sold March 81 calls and bought an 82, 87.5 April call spread. So that is how I'm playing it. That's Facebook. Twitter, just responsive sellers back up at the IPO and the old highs, pulling back. I think the safer play to do is to sell puts on some type of a downward move. You have earnings coming up. I think if it does get a second good quarter, the stock is going to go a lot higher. If they muff it, they're going to go a lot lower and retest these old lows. So that's my analysis on Twitter. Google, again, responsive selling. I had said 77s was going to be the sell point, which was roughly this breakdown. It actually did overshoot a little bit, and now it's coming back down. This, to me, by the way, is no one liked the stock down here, and then everyone had to own it up here. You should have seen what I was seeing on my stream of, Google. No, it already had the move. It came up. This is a pattern which is known as coming up from the bottom, multiple days up, big candles. Of course, it's going to pull back a little bit. If you're still long, 67.45 should be your first line in the sand where it should stay above. I would think that down by 53s is probably a good buy the dip. I'd said that 45.41 in this area here was the breakout. It was. If it comes back down there, I would think you can quote-unquote buy the dip, and that would be my entry point. Netflix, I said, was going to be a sell back up near these reference old highs because we're in a responsive market. It was also forming this wedge. I was in some discussion online. Once that wedge broke, you kind of had to be out. You've now taken out this breakout point, a little bit weak. So, but I would say that between these 48s and 57s, it's still quote-unquote still kind of healthy. I would be a buyer down in the lower, closer to the earnings gap range. Like if this does something like come back down and retest the 200 and the 50, I'd be a buyer down there for right or right out. That is my opinion on Netflix. I think that it needs to correct just because you don't have good trade location up here if you're playing for the breakout. I do think that this will resolve higher at some point. It's going to depend a little bit on the market, but I would be a buyer down here closer to those MAs. Priceline. I had said that the ideal scenario was some type of a chop underneath here and then break out, and to buy it on the break of the down channel. It tested multiple times and now it's coming down. Anything below 12.2288, there's no real need to be long. That's the earnings gap. You really want to be above that. Anything below, if you're long already, you don't want to see this thing get below 195.36. If you do, you're into the gap and there could be a move back down. I would say that the 200 MA and now the 20 MA, this area to me would be a good right or right out play. It was also these reference highs. If it's wrong, just get out and it'll correct more. So my play is either row down here, right or right out down here. I don't know if you're going to completely fill the gap. About down to here, I think would be a decent, like I said, decent risk reward for right or right out. But for me, the better play is the break up to buy it on momentum. Momentum stocks, you want to be long when they're going up and you want to be short when they're going down. I would rather be long on this thing on a break of these highs to fill up the triangle, so to speak, to get to these highs of the 1329. That to me would be the play in Priceline. Tesla, choppy. Again, another one I said I would be a buyer over the down channel or over this swing high. So anything below this 225.49 to me is still vulnerable. If it does wind up coming down, I would be a buyer on the channel. There could be a right or right out play on this 177 area. If that's wrong, you can flip and maybe do some type of a put ratio where you're long the 177s and then short something lower on the lower part of the channel, like 158s. I would be a buyer down here for a bounce somewhere to mid-channel, maybe to this breakdown point of the lows of the 193s to 203s. If we did something like come down to here, I would play it for a bounce back up into like this area. I would think that this area would be a resistance point because it had been so strong support. So that's my thinking on Tesla, either buy on the low of the channel or in a break of the down channel. I think that would get some violent price action back up to the 245s. Anyhow, that's my story. I'm sticking to it. Be sure to like this video if you liked it, and be sure to follow me on Twitter. My handle is @JustinPulitzer. I'm going to post a bunch of links to that Benzinga interview in the description, and a link to my risk management 101 Price is Truth short. I did a good risk management video. I think if you haven't seen it, it's a good idea to see it. Anyhow, cheers, and let's have a great week.